Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Jack Bishop, investment manager based out of our Manchester office. And this week I'm pleased to be joined by regular commentator and head of fixed interest research, Richard Carter, and Carly Moorhouse, one of our fund research analysts covering Asia and emerging markets. A very good morning to you both. So a busy week last week, despite things meant to be calming down over summer. The week began, we had a surprise announcement that Nvidia and AMD would be able to sell chips into China once again, but on the proviso that companies pay the US government 15% of all sales revenue. So quite an unconventional arrangement, but very on trend for the administration. Taco struck again. For those unfamiliar with the term, Trump always chickens out as there was a further extension of 90 days to the deadline between the US and China. In the US, important inflation data, both CPI and PPI were out, which we'll come on to talk about, as well as Q2 GDP in the UK, which came in at 0.3, which was okay, depending on how you want to spin it. We'll get Richard's thoughts on that. And also some data out of China, again, we'll discuss with Carly. And then right at the end of the week, we had President Trump meeting with President Putin in Alaska to discuss the ongoing conflict in Ukraine and in an attempt to try and reach some sort of agreement. So definitely echoes of the Munich Agreement of 1938, appeasement of a dictator, no consultation with the actual company it will impact. So we'll get Richard's thoughts as well on that. So firstly, Richard, starting maybe with CPI, I think. So headline inflation remains steady, 2.7, and that was slightly below analyst expectations. Core was up 0.3 on the month, fastest pace since the start of the year. So the market seemed to take the print quite well, despite that acceleration in core inflation. Why do you think that was? And does it really kind of help the case for a September rate cut?
Yeah, I think the market took it well because it, as you say, it confirmed that there's a decent prospect of a rate cut in September. I mean, not as you said, not all the data was okay, but if you the acceleration was mainly on the services side. If you look at the goods side, and everyone's watching out very closely to see if there's sort of inflation coming through from the tariffs, and there wasn't really any great cause for concern in these numbers. So, the market hopes that the Fed will be relatively relaxed about the inflation side of things and will focus on slowing labour markets and then deliver a rate cut in September. Certainly Donald Trump would be happy with that. But so the inflation numbers certainly were a bit of good news for the markets.
And then following that CPI, we then had PPI, and there was an upside surprise. It came in quite a bit higher than expected, I think up to 3.3 on an annual basis. Services, as you mentioned there in the CPI print, was a major contributor. Do you think we may now start to see a bit of that feed through? And how do you square that circle with the CPI being in line? Are people absorbing the costs in the supply chains, or have we just got that lag before consumers might start to take a hit?
That's exactly it. I think it's just a bit of a lag. The CPI numbers suggested that consumers aren't facing much in terms of inflation from tariffs, and the rise in tariffs is being absorbed by companies. However, producer price inflation suggests it's coming down the pipe fairly quickly, and that margins aren't going to be squeezed forever, and these costs are going to be passed on. I mean, it's not going to be passed on probably one to one for consumers, but there's certainly enough in that PPI report to suggest that the Fed will be a little bit cautious about saying, for example, tariffs aren't going to cause any inflation problems. We can get on and cut rates. There was enough in that PPI report to suggest to hawks on the Fed committee that they've got to be a little bit careful before going and slashing rates, despite what Donald Trump might want.
Guess we'll maybe get a bit more of an insight this week with Jackson Hole. And then on the UK, touched on the GDP figures. Just a quick thought on what that looked like.
Yeah, I mean they're okay, a little bit better than expected, but let's be quite honest. The UK economy is not exactly firing on all cylinders. I mean, the latest numbers were boosted by government spending, which is the last thing you want to see when everyone's worried about kind of the whole fiscal picture, whereas domestic demand seemed to be not brilliant. The fact that real wage growth is coming down, the employment market is not as good as it was, food prices, all that going up. It's still not a great situation, and in the UK, and I'm afraid everyone's getting increasingly concerned about what the budget may present us in November, with the whole kind of potential for tax rises. So yeah, the numbers were okay, but didn't really change the outlook for the UK at the moment.
And then just finally, I know we mentioned it earlier on, what was your kind of takeaways from the summit in Alaska? I know we'll hear more this week, as well as Zelensky's in the White House with some European leaders.
Yeah, well, you mentioned Munich, and I think that's right. I mean, in 1938, it was the Sudetenland that the Germans wanted, which contained a lot of the border defences in the Czech Republic, getting a bit into history here, but arguably there's parallels with what the Russians want in the Donbass. They want the areas of the Donbass where the Ukrainians got very strong defences. If they can get them to give that up for nothing, they'll save themselves a lot of time and costs in terms of military loss of soldiers and all the rest of it. So it's a difficult situation, and it was a real shame that Trump, having talked tough on the Russians for the last couple of weeks, after a couple of hours with Vladimir Putin in Alaska, seems to completely change his tune. And is now putting pressure on the Ukrainians to come to the table and agree a deal, which would just be crazy for them to sign up to be quite honest with you. So more talks obviously going on this week, but hopefully the Europeans will do a good job of sticking with the Ukrainians and persuading Trump that the onus is on the Russians to give ground, not the other way around.
Yeah, absolutely. Thank you, Richard, for that. Carly, if we turn to you now, one of the big themes throughout the first half of 2025 was a weakening of the dollar, and historically that's been a tailwind for emerging markets, and there's definitely a correlation between the performance of EM and movements in the dollar. So just to begin with, for the listeners, I think it'd be helpful, could you just give us a breakdown of the constituents of the emerging markets index? I think people automatically think of China, but maybe for giving a breakdown, it might give some context to how we think about the space and maybe how that breakdown's changed over recent years.
Yeah, sure. So if you're thinking about the MSCI Emerging Markets Index, there are 4 big constituents, which are China at about 30%, Taiwan at 20%, India at about 17%, and South Korea at 11%. And then after that, the next largest market is Brazil at 4%. And this has changed a lot over the last few years. So, for example, back in 2019, Brazil was double where it is today, and both India and Taiwan were half what they are today. And China was approaching 35%. So back then, China really dominated the performance of the EM index, whereas today, there is much more diversification, as you've seen countries like India and Taiwan in particular grow in importance.
That's really interesting. Really helps to shape the next few parts of this. We alluded to the truce earlier on, but maybe if we just focus on China for the time being, the economic data we had at the end of last week seems to suggest maybe a bit of a slowdown in momentum. So industrial production, retail sales expanding, but at the slowest pace so far this year. Could you just give us a bit of colour on that data, and should we be reading in really too much into 1 month's release? Are there other signs that maybe the economy might be slowing?
Yes, so retail sales in China grew at an annual pace of 3.7% in July, slowing from a 4.8% pace in June, while industrial production rose 5.7% year on year, but that was down from June's 6.6% increase. We've also heard that investment in fixed assets is slowing. So overall, China's growth figures did underwhelm, but it's not really a huge surprise given the economic challenges there clearly still are on the ground, which isn't being helped by the tariffs, which is why I think the reaction so far has been fairly limited. Just today, the Shanghai Composite hit its highest point since 2015. And that's been driven, as you mentioned before, by an easing of the US-China trade tensions after they agreed to extend their trade truce for another 90 days last week. But it's also been driven by strong domestic investor participation from locals. And, while tariffs are high, I think on aggregate over 40%, there is a view that the government has many more levers it can pull with regards to stimulus, and it should be stimulus that helps to boost domestic consumption. So, China has a savings culture, and people have saved a lot of money since the start of the pandemic. It's estimated to be over $7 trillion. So it isn't that people don't have the money to spend, they just don't want to. They're still cautious on the ground, and what the government have done so far clearly isn't enough. Unlike in the West, they haven't had at any point any checks handed out or anything like that. What they've done is mainly around trade-in subsidies for things like home appliances, as well as efforts to subsidize consumer loans and give financial support to encourage people to have children. So the view is that the Chinese government can do a lot more, and this latest round of weak data could be the catalyst for that.
That's really helpful, Carly. I guess that feeds into the whole deflation narrative that we've got in China at the moment. Sticking kind of to that, the past results season has been really strong, particularly from the Magnificent Seven over in the US and the whole AI theme. What read across is there to some of the regions under your coverage and the companies listed there?
Yeah, so the AI theme is one that has impacts in Asia and EM too. You obviously have the companies that are directly linked to the likes of Nvidia simply because they're in their supply chain. So names like TSMC or SK Hynix. On the other hand, those that don't manage to meet the requirements can be negatively affected too, which is exactly what we saw with Samsung last year. But Taiwan and to a lesser extent, South Korea are known for being tech-heavy markets linked to global growth. And that's because there are so many companies in these markets that are integral to tech supply chains and therefore AI. So, when the US AI names run, the majority of these do too. However, as we hear more and more about the US tech giants plowing billions into AI capex, similar is happening in Asia, particularly in China. They aren't talked about anywhere near as much as the Mag 7, but in China they have what they call the Terrific 10. And similarly, they're the tech giants driving real change over there. And it seems like a distant memory that DeepSeek came out with their kind of revelation in generative AI. But just because the headlines have fallen away doesn't mean that this isn't still all rumbling along in the background. I think when it comes to tech and AI in particular, China is the main country in Asia there. And animal spirits in China have been revived, particularly since President Xi's very public meeting with all the tech entrepreneurs earlier in the year, showing his support for private enterprise. And people in China have seen the success of DeepSeek and more recently things like humanoid robots, and they want to create the next big thing. When I was on a research trip there in March, it was evident how much of an impact AI is having on businesses, whether that's for the analysts I spoke to when doing their own research, through to the consumer-facing companies already heavily adopting it. So I think while AI is clearly a theme in the US, it is in Asia too, but maybe for those that don't focus on emerging markets, they might not realize the extent and pace to which it's advancing across multiple application areas, probably until we have another DeepSeek moment.
Perfect. Thanks, Carly. And then another heavyweight in the EM index, India, has struggled year to date. And despite Prime Minister Modi seeming to have quite a good relationship with Trump, country has been in his firing line. So could you just talk us through the reasons why, the impact that might have had on the Indian market and how we're more positioned as a house?
Yeah, the way Trump has turned his attention towards India in a negative way is surprising. particularly, as you mentioned, given his previously strong relationship with Modi. Just a few months ago, back in February, they had a very positive meeting with discussions around increasing bilateral trade quite significantly. So it certainly seems a bit out of the blue, as does the fact that Trump is focusing so much on India's oil purchases from Russia while not making a big deal about some of the other countries that do the same. And no one knows why Trump has taken this stance suddenly towards India, but it obviously hasn't had a positive impact on Indian markets, as you can imagine. And actually, India is one of the worst performing markets in EM and Asia this year. Part of it is due to a growing concern that the consumer is slowing in India. And actually, given how domestically oriented that market is, something like that is going to have much more of an impact than tariffs. And actually, Indian equities, last time I looked, were up over 1% this morning amid plans to cut the consumption tax for the first time in nearly a decade. But nonetheless, the headlines we've seen recently around tariffs are not helping. We've also seen downward revisions to earnings there, hence the government thinking about on the ground stimulus. But all of this is going on at a time when valuations are still high in India, particularly relative to other parts of EM. So we've definitely seen a rotation out of expensive India into cheap markets like China, Korea, and Brazil. I would say that many EM investors, including ourselves, are still very positive on India over the long term. There's an incredibly compelling story there that will play out over the next few decades, really, driven by real structural growth drivers like strong demographics and a very positive reform agenda. But over the short term, valuations are off-putting, especially given that there are some challenges that India has to contend with. And for that reason, we are underweight Indian equities at this point in time.
Very helpful. Thanks, Carly. And then just finally, sorry to put you on the spot, but crystal ball time. How do you see the rest of the year panning out for EM? Any kind of things on the horizon that could pose a risk or any catalysts that you can think of?
Yeah, so at the end of last year, I said that I believed that things wouldn't be so bad for EM and that they might surprise on the upside, as I didn't think Trump would go ahead with all of his tariff rhetoric. It certainly felt like that wasn't the case on Liberation Day when he pulled out that huge sign. And then again, when China and the US just kept one-upping each other with higher tariffs. But on the whole, despite all of the headlines and volatility, as you said, EM has performed well this year. And that's because valuations are attractive and investors are finally starting to look outside of the US for returns. The valuations may have initially attracted people, but I think when you look underneath it all, you realize there is a huge amount going on in these economies, most of which are domestically focused and uncorrelated to the US and each other, which is really attractive when you have so much uncertainty driven by geopolitics. Obviously, we can't ignore what goes on in the US and Trump is a risk, of course, and things can turn dramatically in a short amount of time, as we've seen. So that continues to be a possibility. But as I said, there's a huge amount going on in these individual economies, providing so many investment opportunities at, in a lot of instances, bargain prices. And as you mentioned earlier on, the US dollar has been weakening this year. And while EM doesn't necessarily need a weaker dollar, historically a weaker dollar has been helpful for EM. So overall, EM is very unloved and under-owned as an asset class. So there's a lot of scope for flows to start to reflect the opportunity that can be found there.
That's great, Carly. Thank you very much for that. And to Richard for your thoughts earlier on. So did you enjoy our discussion on the podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button and we'll be back next week. In the meantime, you can head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and upcoming webinars and events on our website or on our social media pages. And then finally, we do like to hear from our listeners. So if you've got a question you want to ask one of our experts for the next podcast, just simply ask them via the weekly comments page on our website. And that's it for today. So thank you to Richard and to Carly and to all of you for listening. See you next time.